Broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for attending today's Arena Group webinar. This is entitled Eyes on the Road, and we're going to be talking about the FCA expectations of motor finance. Now, this is actually part 2 of a series of webinars, so thank you if you attended both the first and this webinar. And first of all, topically, I hope everybody's keeping safe and well in the circumstances we find ourselves in. So today we're going to discuss the upcoming FCA changes to FCA regulation for motor finance. And we're very pleased today to have with us our expert, Yasin Sridhar from Conexo. So I'm Neil Maud. I'm Director of Technology at Arena Group. To my picture and contact details on there. I work with Arena's software team to deliver solutions across a number of sectors and markets, including automotive, retail and financial services. We'll say a few words in a moment just to talk about our respective companies, but Yas, would you just like to say a few words of introduction for yourself?
Sure, thanks very much for the introduction, Neil. Good morning, everybody. I'm Yasin Sridhar from Conexo. I'm a director of the Financial Services Advisory Division. We are the alternative legal service provider arm of law firm Evershed Sutherland. And what we work in is effectively regulatory consultancy. We help advise businesses on their FCA, PRA expectations from authorization all the way through to ongoing compliance and to wind down. The advisory division that I work in is part of the tech-enabled managed service, COSEC, and resourcing components of Conexo Global.
Okay, thanks, Yasin. Okay, we have an agenda prepped for today. I'll just do the highlights of this. We've done our introductions now, and we've talked a little bit about the organisations. I will do a little bit of scene setting around the automotive sector in a moment, and then Yas will do a recap on part 1 of our series of webinars here with the things that we covered. We're actually then going to drill more deeply into some of the specific areas and the actionable points for automotive retailers. Some of the things that are actually going to happen on the ground that you need to be considering. So Yas will present on those matters. I'll do a little bit of a summary then, and we've set aside some time for Q&A. And what would be really good would be if people could just drop their questions into the chat window on the webinar tools. I'll be keeping an eye on that throughout, just to see what see which questions are coming up. If there are any patterns, then I'll try to ask the most recurrent ones. And we'll just try and get through as many questions as we can at the end. So please submit your questions via chat at any time. We'll keep an eye on those. So, yeah, imperatives. We have this slide in our presentations, and I've talked about the different imperatives through a number of webinars this year and last, just setting the scene for whatever the topic of the day is. And there's been some standard trends here. Regulation and compliance is on the increase, so are customer expectations, and everybody wants to develop a competitive edge. There's a lot of pressure to do more with less. Okay, and that's kind of a business standard, really. It's happening all the time, but in this particular situation that we find ourselves in now, I don't think there's been more uncertainty in the business environment at any time in my working career. So this changes the sort of business, the discussion that we might have been having otherwise when we first planned out these webinars. The uncertainty for me is around what is the future going to look like when the COVID situation starts to whatever the new normal starts to become. What's that going to look like? How are we going to go about doing business? How are we going to manage our interactions with customers? And it brings a couple of key points to mind. What should we do in the short term while we're in this situation now? And what should we do in the medium term and positioning ourselves for the upturn when this inevitably, the business environment inevitably changes from a lockdown situation? And we're starting to see, I think, some changes now, and people, a month ago when we did our previous webinar, everybody was, how do I get to remote working? How do I deal with some of the tougher aspects around furloughing staff and so on? Now we're getting from the market people saying, okay, I've done that, and we're probably going to start doing some trading shortly, and that might be some online trading, some distance selling. And this is bringing a whole new set of issues, which certain parts of the industry have been looking at, but other parts of the industry have kept separate left to others. I think when we do more, we're inevitably going to do more home working, and we're going to do more distance selling. And this brings issues around process management, and is particularly relevant today, ensuring controls are in place and sustaining oversight for people who maybe you don't see all the time, who are doing more distance selling work, so they're not seeing their customers all the time, they're transacting online. So preparing for regulation is a good thing to be thinking about now. It's not going to go away, and it's an area where you can position your business much better for the upturn. So I think we've got a really important matter to discuss, and without any further ado, I'll hand over to Yazin.
Thank you, Neil. Just checking if everybody can hear me. I had to switch my headset, unfortunately. The battery died, so apologies for any technical difficulties you experienced or odd little pop-ups you saw on the screen.
You're coming through loud and clear now, Yazin.
Perfect. So today what we're going to cover as part of this webinar is a follow-on from the first part of the series around recapping the key changes that the FCA is intending on bringing in for motor finance, going over the kind of discretionary commissions and amendments to disclosures. We won't hang around that for too long, but it kind of helps put things into perspective when we talk a little bit more about what the FCA's expectations are regarding conflicts of interest, which underpin some of the changes that it's making. Then we're going to talk about a slightly bigger picture component of this, which sometimes gets overlooked when you get too into the detail of what the FCA's changes are, and that's really around firm governance, oversight by management, and the tie-in to the recently introduced senior managers and certification regime, and how it links into both individual and firm accountability. Then we're going to spend a bit of time talking about how the FCA has come out with some recent documents around how firms should react in light of COVID, and some leniency as well as guidance around how to manage compliance programs, as well as specific components for the motor finance industry, which we'll talk about. Then we'll go into how to actually manage regulatory response from the perspective of implementing a regulatory change to dealing with FCA queries to see if you have done what they've asked you to do. And then finally, we'll go into what we actually kind of really need to discuss as part of any type of compliance webinar, and that's what is a robust compliance program? What does it comprise? Who are its key players? And how do you maintain this going forward? Before wrapping up with some Q&A. Recapping the changes that we discussed last time, the FCA's consultation paper, which closed earlier this year, set forward some pretty stark changes for the industry around discretionary commission models, as well as the disclosures that are given to customers upon point of sale, as well as in marketing material. So it found that increasing and decreasing DIC, difference in charge commissions, as well as scale commissions, which are interest linked, were not really of benefit to the end customer. In fact, it found that customers were getting ripped off by the industry owing to conflicts of interest arising from this model. What it said is that it's going to ban these types of commissions, which would allow other types of commissions to continue as long as they don't kind of fit the mold of interest linked. And they're going to improve the disclosures that are actually given to customers. And those disclosures are meant to really talk about the nature of the commission to help customers understand what it is, and to make them more informed when they make their decisions regarding their car finance options. In terms of the timeline for implementation, and we've had a couple questions on this already before the webinar even started, is this still going to come in Q2 2020, the policy statement? As far as we're aware, the FCA is not going to release anything that says that they're delaying this implementation. However, given the fact that the FCA, as you would imagine, is very much focused on making sure firms survive this current crisis, it could be that they end up delaying some of this, but as of this point in time, they have not indicated that they're going to push back their policy statement. Once that policy statement comes in, Q2 2020, as we envisage, there will be a 3-month delay to implement the commission changes. The disclosure changes, however, will take immediate effect, and we don't envisage that would change in any event, despite current COVID circumstances. The FCA is then going to monitor thereafter whether this rule has been implemented appropriately, and unless something kind of changes with their monitoring program, we envisage this is going to stay the same. And then finally, they're going to conduct a review on how it actually impacts customers down the line, because it's all fine and dandy to say 3 months after implementation comes in that the black letter compliance has been done, but what's the impact on customers that change their buying habits? Have they become more informed? And that's scheduled for 2022. However, I do feel that with current circumstances, perhaps some of their monitoring program will change, and that might get pushed back a bit. But ultimately, there's no point in crystal ball gazing about it. We'll wait and see, because the implementation is probably going to come in as it's been prescribed. Last time, we'd also talked about some of the underlying issues and why these changes have been brought in. And those really kind of center on vulnerability of customers and affordability. Vulnerability being the fact that up to 50% of UK adults over the course of their lifetime could become vulnerable for reasons of sickness or financial circumstances or emotional shock, and how to account for that when making services for the client. And affordability is really about, can the customer afford the finance option that you provided for them, given their current expenses, financial circumstances, family commitments, etc., and how to account for that on a systematic basis.
Okay, yes, if I can just jump in on that, just to clarify there, because we have had a couple of questions around this. The timeline is, I think you said, unchanged as far as we know, in light of COVID. So FCA wishes to, to proceed and stick to this timeline to the absolute best that they can. Is that right?
That's correct, yeah. So the FCA has been really good about keeping the market updated about what its strategies are and if there's going to be any delays to consultations that it's doing. So it will keep the market posted if they are going to delay this implementation. However, realistically speaking, unless something has changed in the chapter and verse of what they want to publish, or if they're having difficulty in actually finalizing the policy statement, it's safe to assume that it will come in at some point in Q2 2020.
Okay, good. And another question we had was around this affordability, and it's jumping around a little bit here, but we had a question which is, who does the auditing or checking of whether the affordability assessments are being done correctly or being done well by the retailer? Is that something that the FCA does, or do they have other parties who would come in and do that?
It is something that the FCA does. The way in which the FCA is structured is that not one single person will know every single component of regulation at the FCA. It's impossible. So it's divided according to sector, and then within that it's divided according to streams like authorizations, ongoing supervision, as well as enforcement. So there is a team within the FCA that will look at what their affordability criteria are and compare it against what they see firms doing in the market. So it's a bit of a compare and contrast exercise, as well as a learning experience for them if they go out and supervise the market, because they can see in practice what firms are doing. So yes, it's definitely still run by the FCA. And if you read the case of Money Barn, which we're going to go into as a case study later on today, you'll see kind of how they break down, at least from the enforcement perspective, that type of review and on the basis of affordability.
Okay, thank you.
So I think last time we talked a little bit about conflicts of interest, but more kind of a focus on vulnerability and affordability. But this time, let's talk about why the FCA feels that conflicts of interest are a problem, not just in motor finance, but across a variety of financial services industries. So the FCA's approach to addressing conflicts of interest depends on the circumstance and depends kind of on a question of, do they think that the conflict of interest can be managed, or is it something that's just so great that they can't envisage the industry kind of coming to terms with it and managing it in a way that's beneficial for the customer? So they have two standard approaches to this. One is to ban a conflict of interest. So we've seen this here with the discretionary commission models, is that they find that there's a conflict between the customer, the lender, and the broker, where the customer's interests are not aligned with those of the lender and the broker. So what they're saying is that alignment, there's no way to kind of manage that in practice. So we're going to just prohibit this practice from arising in the first place. That's kind of the easiest way to go about this, but it's probably the most stark and drastic measure that they can go and manage. The second is really around conflict management. So conflicts of interest happen in all walks of life, and especially within financial services. There's the optics of conflicts of interest, and then there's the reality of it as well. And if a conflict does arise, the FCA wants to know that A, you can identify what these conflicts are, and B, that you can kind of manage them. And by having the disclosure requirements, this does mean that the FCA feels that once the discretionary commission models are out of the picture, if you let the customer know what the commission arrangement is, that will help them make a more informed decision. And by doing this, they're trying to build out customer education, which is a key point around the disclosing. So those are kind of two main messages around conflicts. But we can look to other sectors if you want to look at where this theme of trying to manage conflicts of interest or ban them comes from. So if you look from the banking sector, there was mis-selling of financial services products, taking really complicated investment products and selling them to people who just didn't have the knowledge, experience, or even the interest really to kind of understand them, because they were kind of led by someone that they trusted as an advisor. And the FCA said, well, you're getting a commission on this basis, but this product is not only not of interest to the customer, it ended up being a kind of invalid product in the end. If you look at anything that was mortgage-backed security or any type of products that were based on that. So they've prohibited some of those products from arising, and then they've increased kind of conflict management before disclosure as part of that process, saying it's not good enough just to tell your customers that we have a conflict. You have to really take the steps to mitigate that in practice and justify why you have it. And that style of conflict management is a lot more evident in the asset management space for inducements. So under MiFID II, there were some significant changes to how asset managers could acquire research from their brokers. So what used to happen is the asset manager would take client funds, go to the broker, buy whatever securities it wants to, like an Apple, or it would short Vodafone. And as part of that service, they would get research. They get research on a given stock or on a wider basis of the market. And effectively that pricing was built into what they were paying for these securities. Now that pricing wasn't transparent. The funds never really understood what the money was being spent on or the value of that research. So what the FCA said is that we're going to blanket have a prohibition on inducements unless they're of material benefit to the client. And if you do have this research, it has to be a separately identifiable charge, and you have to inform the fund of it and budget it with them and agree how much they're going to spend. And so what we've seen is a really kind of significant change in the industry, whereas before MiFID II, funds were paying for all of the research, and now firms have actually decided we're going to pay for this ourselves. We're not going to charge it to the fund because it's just too much of a hassle to do it along the lines of the way the FCA kind of envisaged. And what that means is that the firms are actually taking ownership of trying to prevent that conflict of interest from arising by paying for it out of their own funds. The final point is really around kind of aligning interests. And this is the key thing when you have any type of conflict of interest, is that the alignment is not there or it's not sufficiently protected. And what they want to see here is that the broker, effectively acting as an agent, is able to ensure that the customer is able to get the right product, but then also able to ensure that the lender is not going to get caught into like a bad deal, and that their risk is being priced into how those finance arrangements work, because it's supposed to be, right? The FCA is not saying that you're supposed to be giving out free credit. It should be priced in according to what the risk is, and there should be justified and auditable metrics that you use on a case-by-case basis.
Yes, and if I can just ask a question there around something of the banning versus disclosing versus accountability, really. What would you say this is going to look like in the practical scenario of, in automotive retail, are we going to see less discretion because certain ways of operating are banned? Or are we going to see more responsibility and accountability, and possibly, filtering down through different levels within the organisation? What would your views be on that?
Yeah, it's a good question. It's an interesting one too, because in a sense, there's less discretion because certain types of commissions are no longer going to be allowed. So you don't have as many options. But at the same time, you still have discretion in terms of how you behave, how you engage with the customer, and then how you identify what their interests are and what is actually the best option for them, because there's still options available. I think that really hits your point around accountability, because the accountability regime, which we'll go into a little bit later, which is kind of SMCR governance oriented, it's really about your interaction with the customer and building that idea of treating customers fairly, which we talked about in the first webinar, at the core of your business. And if you're not able to do that on a consistent basis, then the FCA is probably going to take issue with your setup. So I think to kind of answer your question, in some, there will be less discretion and more emphasis on firm as well as individual accountability, not just at an executive level, but kind of down the chain all the way down to the sales floor.
Okay, thank you. I mean, I'm hearing there's going to be some clarity about, certain things are, you can't do this. Other things you're clearly going to be able to do, but you're also going to be clearly held accountable for that.
Exactly, that's right. So the FCA is not trying to say that they're going to prescribe how the business should be run, but they are going to say that there are some checks and balances that you need to have to make sure it's run in a way that doesn't harm customer interests.
Okay, thank you.
So we've talked about why there's conflicts of interest in the motor finance space and why the FCA is interested in it, but how do you actually deal with it in practice? And some of you may already have this system already set up, but it's ultimately about addressing conflicts when they arise. So putting aside for a moment the fact that some of these conflicts are banned, so that the certain discretionary commissions, once other models are taken in future which could potentially replace this or find another way in which customer interests are not aligned to broker and lender interests, or even other conflicts in the business, you need to kind of identify what these are and do have a bit of a thought exercise about what are the hypothetical conflicts that it could impact our industry, and not kind of going really far beyond the pale and trying to find and reach out for conflicts that are imaginary, but thinking hypothetically, what could impact our business and where does it come from? And then you also need to set up what the actual conflicts are. So what are the ones that have arisen in your practice? Where have they arisen and which parties are involved? You'll have what's called an inherent risk. So what is the risk that that conflict could do damage to your business, or that you could be in breach of your FCA obligations, just without any controls, just looking at that conflict face value? That is your inherent risk. Then you institute a control. So let's say your control is, okay, we're going to monitor periodically for these conflicts. We're going to keep them on a register. We're going to ensure that the conflict or potential scenario is either removed or abated using XYZ. And then we're going to monitor and test against this control on a periodic basis. That would be the control that you would put in. And then it kind of turns out what's called a residual risk. So having accounted for your controls and how strong they are in actually managing this conflict, what is the actual risk to the business now after this control has been instituted? And that residual risk will ultimately tie into your kind of monitoring program. So once you've identified the conflicts that are at hand, you need to take steps to manage them. So I mentioned the conflicts of interest register. It's meant to be a kind of continuing document. So you should maintain it periodically and update it whenever you do see that there are conflicts. And if you do change your controls over time, because they're not meant to be static, and it might be that you find that actually in future, maybe you have less conflicts than you used to, and that control has done a really good job and you don't need to monitor it as much, or you don't need to have as strong of a grip. You can update your controls, or you can update them to say, actually, we need a little bit more. So you have to update them in light of testing and in light of what you see in practice. And then the final component is really around disclosure. And the FCA tends to want firms to avoid disclosure unless it's a measure of last resort. So if you've done all you can to identify and manage a conflict in-house and it still exists, there's still a residual risk, how do you broach that with the client? And how do you make sure that they're informed enough to say, we have this conflict inherent within this particular component of our business, wanted to bring it to your attention. However, we are still giving you the best customer outcome that we have possible, and this is how we're doing so. So it's really about kind of evidencing why the conflict is being managed in practice and why it is that you are kind of attending to the customer in the way that they want to see.
Okay, just on these the risk registers, and as businesses we all have lots of risk registers for various purposes. But is this register of conflict something new, Yas? You know, I guess there's going to be businesses who've thought about it and done it already. But was it a previous requirement that's now being expanded? And a second question, really, how much work are we looking at here? How big a deal do you think it's going to be for a retailer to get their head around this?
So good question. It's a requirement that's been in existence for a while. It may not necessarily have been articulated in a specific rule by the FCA, but when they do come to review firms' conflicts of interest programs, they will ask for a register. Because without a register, not only does the firm have no idea where their conflicts sit, but the FCA doesn't either. If you think of the FCA in the same way as you think of a auditor of your accounts, if they don't have evidence of it, then they can't make an assessment, or they just assume that the rule hasn't actually been complied with. So it's not a new requirement, but I think building it out in light of these changes will probably be something that firms will have to do. In terms of how much time it's meant to take, it's meant to kind of at least stimulate a bit of a thought exercise about where conflicts lie in the business and how it impacts customer treatment. But it's not really meant to be something that we're supposed to spend an absurd amount of time thinking about conflicts that you'd never thought about before. I think a lot of these conflicts have kind of already been bubbling up under the surface, and firms are probably aware of where they sit already. But in light of FCA guidance, it will help mold and shape their direction a bit. So hope that answers the question.
Yeah, I think so. I mean, it feels like there's a more solid steer as to how to use this conflict of interest register, and I think that's got to be a good thing. Thank you.
Exactly. So firm governance, and this is a really important part of what the FCA is trying to get at. And this was brought up as part of their review of motor finance dating back from 2017, and it continues today. I think the way the FCA positions it is, if we ban these particular commissions and if we improve these disclosures, it helps in some respect, but it doesn't help in terms of the next thing. So if something else arises in the industry or there's a market practice in future, which gives the FCA some discomfort that customers are not being treated fairly, how is it that the industry can pick up on this, or how is it that you as a firm can pick up on this before the FCA does? I think ultimately it's a question of oversight, both by lenders and by brokers as well. So what the FCA found as part of its review is that although there are kind of a range of really interesting monitoring practices prescribed by the lenders over their brokers, these weren't actually kind of reviewed in practice. Firms were relying a bit too much on some of the contractual terms and paper arrangements to actually control behavior. So it's kind of like prescribing something in a policy and then not checking to see if it's been done. And what the FCA is expecting here is for lenders to kind of go on site to brokers and actually take a look under the hood and see what's going on a periodic basis, on a risk-adjusted basis, but then also to kind of get sufficient data from their brokers about whether or not these lender controls are actually being complied with. So ultimately, it's about a tie-in with treating customers fairly. So if you as a business have been told that the entire industry you work in, the FCA is concerned about an underlying theme of treating customers fairly, how do you have comfort that treating customers fairly is being upheld at different levels of that business? Because it's not just one firm does its own thing and another firm does another. If you're a lender, you do prescribe controls based on the particular finance arrangements that your brokers are engaging for customers on. So you need to kind of understand how treating customers fairly plays into this, as well as have some kind of metrics and data for how to understand if that's being applied in practice. Now, we have a case study here, which is relatively recent.
Hi, Yaz.
case study.
If you don't
Sorry, go
mind,
ahead.
might I just sort of jump in before we get too much into the case study, because we talked there a lot about process management stuff, and I don't want to do too much product in here, but process management is something that Arena helps motor retailers with quite a lot. We're actually putting in place a process management workflow. So we're wrapping around the current processes and saying, okay, as a transaction is being managed, can we have visibility to everybody who needs to see that? And can we build up an audit trail of what has happened? And this is somewhere that we've helped a number of automotive retailers really get that visibility, be able to report on timings of activities, who did what, were the correct checks in place, were indeed cooling off periods observed, and so on. So this is something where the producty type stuff that we do, and I'd encourage anybody to go and look at our website to see some of the examples of that. This is where we can help our customers to streamline the implementation of this kind of oversight. And make it easier for compliance managers to look across multiple sites without necessarily having to travel there every day, but take out some paper chase as well, so that compliance managers can actually be looking at the right things, spending time talking to people, spending time educating, rather than spending time searching for documents. So I just thought that's something I just wanted to roll into that, because it's a potentially a takeaway action.
Yeah, definitely. I think the kind of the process management, as well as setting up, for lack of a better word, a system whereby you can ensure oversight, as well as kind of auditing, being auditable, and having documents on hand, is really important in actually ensuring a robust governance structure. And in the case of Money Barn, perhaps there's some lessons that can be learned from that can be built into your process. So Money Barn, car finance provider, were fined £2.77 million, and this is kind of around. They were in the non-standard space for customers who were seeking car finance, and there was already a risk that some of these customers wouldn't be able to pay according to the terms that were set. So the terms that were set were unrealistic, and Money Barn, according to its policies, procedures, as well as its forbearance protocol, weren't giving customers the opportunity to manage their arrears over a realistic time frame before the deal was terminated. So ultimately, this is a question of affordability, as well as looking at vulnerability, so how changes in employment could impact your ability to repay. The FCA did point out in this case, if you go through it, that even though the focus area is around affordability and vulnerability themes and treating customers fairly as an overarching theme, if oversight of these practices had been better, it would have helped inform management of what was going on, as well as amended their policies and procedures and forbearance protocol. So this would definitely have been a help to Money Barn if they had a kind of oversight process which was a little bit more robust and consistent with FCA expectations. So it's really difficult to talk about governance without talking about senior managers and certification regime. So I'm sure all of you attending today are aware of this regime and have had the joy of having to implement it for your businesses. As of December last year, we've been working at Conexo on SMCR since before it was actually introduced for banks, quite a few years back, I guess 2016, 2015 time. And we've seen the evolution of SMCR from both the regulators' eyes as well as industry by industry, how they've managed to implement it and what it really means for them. To kind of break down what SMCR is, it really comes from the banking environment of the FCA not being able to pick out individuals for misbehavior given their existing rule set under the approved persons regime. So in the same way that firms are authorized to undertake regulated activity, individuals would have to be approved to undertake certain activity within financial services, and that approval would be by the FCA. The FCA felt that the regime wasn't credible after the financial crisis. They weren't able to take the action that they wanted to. So what they revamped this into was the senior managers and certification regime, which is broken down into three main parts. So you have senior managers, who are your C-suite, your risk managers, your compliance officer, your money laundering reporting officer. And these are individuals who still have to be approved by the FCA. You have your certified regime. So this is your former CF30s, your client dealing functions, other individuals who could cause harm to the business. And the main change is that, unlike before, the FCA is not going to say these people are appropriate to work in financial services. They're saying that every single firm needs to do a fitness and propriety test of these individuals and certify that they're fine to work in financial services. So you can see how that puts the pressure back on firms to ensure that the people who work for them are indeed fit and proper, have sufficient kind of financial soundness, knowledge, and competence and capability and integrity to undertake their roles. And the third component is the conduct rules. Whereas before there was a series of rules which would apply only to approved persons, the conduct rules apply to all staff. So effectively, when you join a financial services firm, you sign up to a set of rules that you don't really have a choice to sign up to. And this is really around kind of key principles of behavior, like behaving with integrity, being transparent with the regulator, ensuring that you're not doing anything that's abusive to the market, as well as conduct considerations. That's SMCR in a nutshell. Now, kind of how does it apply to motor finance? So the first point on the slide is really around improving oversight, and one of the best ways to do that is through kind of a staff training program. So if you are unsure of your staff's ability to kind of follow the rules, as well as understanding policies and procedures, particularly if you've just implemented changes, and even if your staff are very much on the ball, new policies and procedures can cause a lot of hiccups in terms of implementation and ensuring compliance, because communicating those changes and how they impact the day-to-day functioning of an individual or a certain group of people is really critical. So having those training programs and getting data back on who's attended training, who is having difficulty, will help you understand where the stress points could potentially be for your business. The second point is around having a risk-based monitoring of broker obligations by lenders. So as I mentioned before, the FCA wants to see lenders going on site to brokers and ensuring that the compliance is kind of made, but they want this done on a risk-based approach. You shouldn't be going to every single broker at the same amount of frequency just because they're the broker. You should look at specifically your interaction with the broker, as well as how they've actually evidenced compliance in the past and the quality of the management information which they're giving, which is the third point. It's really difficult to run any type of business without management information, and it's difficult to run it without accurate and consistent management information. If the templates you use from one meeting to the next are not the same, you're going to have difficulties in terms of oversight. And if the quality of the data is not sufficient to make business decisions, then it's also going to cause problems as well. We've seen over the course of the last few years the quantity of data in MI going up significantly, and you have to think about what the appropriate balance is between your executives or non-executive directors having the time to digest and process information, your middle management or your business heads producing this information and taking time away from their kind of management of the business to do that. And you have to kind of strike the right balance between what's informative versus what's excessive. The fourth point is really around kind of having broker relationships as a standing agenda item at committee meetings. And this is something that the FCA noted as an element of good practice that they'd like to see built out a little bit more throughout the industry. And the final point we've already mentioned is around periodic on-site visits to verify compliance. The FCA is not saying that these have to be done every single month or every week or anything like that. What they are saying is that on a risk-weighted basis, you should take some type of assurance work to understand whether or not these obligations are actually being complied with in practice. On the point of kind of SMCR considerations and how it can impact motor finance, the individuals that are involved, there's some key ways that the SMCR regime is perfectly designed for bringing accountability to individuals. Not only was it the reason for the regime, but also there's some mechanisms within it. So all senior managers need to draft what's called a statement of responsibility. That statement of responsibility is effectively kind of miniaturized job description stating what your responsibilities are within the business. And some of these responsibilities are set by the FCA, what are called prescribed responsibilities, such as managing the senior managers regime, the certification regime, the conduct rules, or financial crime. And some of them are set by the business. So it'll say, I'm responsible for this particular business line. I'm responsible for the supervision and development of this group of people. And what they can do is, once you submit that to the FCA, they have that on file. And if they come to do a review and they find in practice that you're not evidencing these responsibilities, they could potentially take action if there's deemed to have been an actual breach. So I would recommend definitely making sure that your statements of responsibility are kept up to date, and that all staff who have signed on for statements of responsibility are aware of what their responsibilities are, and that these are monitored periodically as well. Having a lack of oversight can lead to individual accountability, because it's not just, you can't just hide behind a risk management system or say, it's the firm's fault. If you are a senior manager, you're responsible for particular components of the business, and that regime is specifically designed to hold individuals to account for lack of oversight of their business lines. The third point is really around managing and reporting conduct breaches. This is the FCA's way of preventing bad apples from moving around financial services without any repercussion. And this is not just for what we would call regulated activity misconduct, it's also for non-financial misconduct, such as bullying or harassment. And the FCA said, it's obviously not as prevalent in motor finance as more of a kind of insurance investment space where a lot of these cases have come up, but they don't want things like non-disclosure agreements and blocks on information to allow individuals who conduct themselves like this with their staff and with their colleagues to continue moving around through financial services without repercussion. So once there is a breach kind of identified, how do you know that that breach is sufficient to kind of go to the FCA? Have you had a discussion internally? And then once that decision is made that that's actually a breach, how do you kind of broach this with the FCA and ensure that appropriate action is taken? And the final point there is really around middle management. Everybody thinks with SMCR, it's focused on just executives, and then certified people are all within a pot within themselves, and then there's everybody else. But really, the FCA has actually said middle management is key here, because middle management are the ones with the best oversight of staff conduct. They're the ones who sit between executives and the rest of the business, and they're the ones who are able to actually control and influence a lot of that business. So it's important for middle managers to understand what the responsibilities are to their stakeholders, as well as the responsibilities to the business.
Hi, yes, it's common in automotive retail is a practice where you have a sales executive who's interacting with the customer and shaping the financial proposition, and then they will take a pause, give the customer a coffee, and go and discuss that with their sales manager for their particular department. So I think that there's kind of some structure already there. Occasionally, and as I go and delve in the internal workings of organizations, sometimes you see some odd practices there. But I think what you're saying is that those sales managers are the middle management that you're referring to here, and they need to be they need to be certified, they need to be appropriately trained, and they need to be able to give this oversight. Is that fair?
Yep, I think that's fair. That's a good assessment of how this would work in practice. I mean, as you said, there's already some kind of controls that are in place. It's just a question of mapping it to this regime and understanding what it's asking of firms.
Yeah, I think there's a structure in place, and then there's making sure that the culture takes that on board, understands that, works with it. Anybody who was in the previous webinar that we did, we talked about a couple of cases of not so good there. By and large, practices are good, but yeah, I think those sales managers are key to keeping the right side of all this compliance legislation. Thank you.
Exactly. And that kind of comes down to what the drivers of culture are. And for the FCA, even though this is an individual accountability regime, they have expressed in their publications as well as their interactions with the market that this is really about firm culture. And it's not about having a good culture or a bad culture, but they describe it as a healthy culture. It's meant to be purpose. So what's the purpose of your firm? Obviously, it's to turn a profit, make money. But what are the values of your firm, and how do you communicate those to your staff? Second is really around leadership. So this is not just senior managers, as I said, it's also middle managers as well. How do they practice leadership, and how is it kind of demonstrated throughout the firm? The third, which is I think the key driver of it, is the people. So the people in your firm are the ones who make it tick as well as who can make it flop. And ultimately, they want to ensure that there's some degree of understanding of what they're doing. And finally, and to the point earlier, is really around governance. So what oversight do you have, and is that process robust? So moving swiftly into the COVID updates, tying into SMCR, the FCA is very well aware that firms are struggling in many ways because of the coronavirus, and not just from a strict black letter compliance perspective, but in terms of running the business as well. And running the business is kind of a key component of SMCR. So what the FCA has said here in relation to SMCR is that if you do have to furlough staff who are senior managers, you should really only furlough MLROs, your money laundering reporting officers, and compliance officers as measures of last resort. And if you do furlough them, can the firm actually replace that SMF 16, 17 skill set? Is there someone else who can be responsible for it? Because for them, their idea is that these people are not often meant to be working in revenue generating roles if they're a specialized function, or if they are a specialized function, they're probably senior manager for something else. So if you are going to furlough them, how does the FCA know that you're actually monitoring your compliance and financial crime obligations? The second point there is really around what the FCA has said about furloughing SMF. So you can furlough senior managers, let's say where business lines have been suspended, but do consider delegations as well, who you can delegate that authority to, or you can delegate those responsibilities to an extent. Ultimately, responsibilities vested in the senior manager, but if there's someone else who's still employed who can run that operation, get them to do it, and you can kind of document this internally. The final point is really around, there's no single senior manager who needs to be responsible for corona response. It's meant to be allocated according to the risks that there are to the business, and it's meant to be divvied out across members of the firm. So you don't need to appoint an individual who's specifically going to be responsible for this COVID response. Just think about where the allocations make sense internally. What the FCA is kind of looking for here is around showing responsibility for the oversight of your business, as well as kind of how the senior managers impact it in practice. In terms of leniency and deferrals, the FCA has come out with some useful information and fairly prompt information about what some of the major changes are going to be in light of COVID. So I think the first thing to start off with is that some deadlines for certain regulatory returns have been moved, not all of them. If you go on the FCA website, they have come out with a recent statement about which returns have been delayed. Some of them have been delayed by 1 month, some of them have been delayed by 2 months, and it may be that they add to that list in future, but definitely keep an eye out for that list. I think the major change to talk about is around payments. So if you do have customers who are struggling to make payments, it is possible for them to have a 3-month deferral on making any payments. That deferral is ultimately where no money is taken, or only a token amount of money is taken, such as a £1 payment if your system doesn't allow for zero to be taken. And these deferrals are not considered to be going into arrears. These would be due, let's say, to a reduction in household income owing to current circumstances. They want firms to really consider how these customers can repay over the period. So looking at kind of the interest rate of the remaining term. So you don't want to create a situation where the customer goes into more debt, or when a reduced or waived interest would actually be better to undertake. They have said that firms should not be reworking their PCP, PCH agreements if they cause unfairness or unfair outcomes to customers. And they don't want recalculation of things like balloon payments based on the current COVID depreciation period. It's all about thinking about things in the round. Ultimately, they know that everybody's going through a tough time, and what they're trying to say is don't penalize people for circumstances that are out of their control. On the plus side, they have said that you don't need to inquire about each customers' circumstances for deferral if they apply for it, just to see if it's in the customer's interest. So they are waiving certain consumer credit kind of provisions around this. So it does mean that you can make a bit more of a swift assessment of just saying, look, this person's applied for it, we're going to grant the 3 months, as opposed to having to spend time and resource, which you might not have inquiring into every single customer's personal circumstances if the information that's been supplied to you needs further investigation. They have mentioned that repossessions should be a measure of last resort if caused by current circumstances, coronavirus. If repossessions were already on the card for a while and there's justification for them, they said that you can go do them, but just make sure that you try to observe some social distancing guidelines. Not sure how that would work in practice, but they haven't really gone into a ton of detail there. They've also said that guaranteed minimum future values and residual values, it can be amended if the process is fair to customers. I think this is really the key thing, is making sure that fairness to customers is built into your decision-making process. So do you still consider affordability and vulnerability as part of this? And make sure that you can clearly communicate to your customers what the deferral means for them, or what it could mean for them, and that you can still kind of charge interest as well. So a lot of kind of interesting movement from the FCA to help protect customers as well as firms in some circumstances in light of the current situation. And that continues to get updated every day. So definitely keep an eye out for the FCA website as well as communications.
Yeah, just a comment from me on that, guys. And it seems like that's an incredibly big topic and a fast-moving one. You know, there's lots of messages about keeping customers in their cars, but obviously, as well as that, there are considerations of cash flow, frankly, for lots of organisations. So I think here there are some opportunities, if you do this well as an organisation, that you can stand out and look good by treating customers fairly. And I think the FCA is being mindful of that and is about a balanced approach here. But it is an enormous topic, isn't it?
Yeah, it's probably a topic for its own webinar, to be honest, in terms of the actual kind of operational impacts of it. But at least hopefully today, this sets out what the regulatory expectations are, and then you can kind of go away as a business and assess like how you want to do that in practice, and using your current formulas, or if you want to set up a new kind of line for affecting these communications. Because ultimately, when you look at this, as you mentioned, it is about kind of keeping the customer in their car. But on the other side, there's also cash flow issues to consider as well. I think the FCA has probably accounted for the fact that some firms may be making use of kind of government intervention as well. But I think their focus, based on their mandate, is primarily customers. But at the same time, if they can't protect firms who are servicing customers, then they're not doing their job as well.
Indeed. Yes, thank you.
So in terms of kind of managing regulatory response, kind of going through some of the key areas here, this could be in light of COVID changes, or it could be in light of the discretionary commission bans and amended disclosures. I think I've broken it down to the three easiest things to think about. First is essential compliance. So what do you actually need to evidence compliance around commission removal and amended disclosures? If someone were to audit you, like the FCA, and if you wanted to kind of at least have comfort as a firm that you've done these amendments, what do you actually need to kind of evidence these amendments, and how do you store this information and ensure that's easily accessible? The second point is around kind of prohibition of bank commissions. You may prohibit it on paper, but how do you make sure that it's not actually happening in practice? And this is really coming down to oversight by management. And the final component is around disclosures. So the new disclosures that you create, ultimately you'll compare them against what the FCA is saying that needs to be in them. So that way there's a kind of a template and a format that you can use which is consistent. And how do you build that into your compliance monitoring? Those are kind of the key components of what I would say is essential compliance. The second point is, as Neil said, it's an opportunity to stand out. You can showcase compliance as a bit of a value add. Now, it's not one of those things you can say on your website, we're 100% compliant and the FCA loves us. And that's not meant to be that type of a marketing thing. It's meant to be through user experience that you can highlight that the customer is at front and center of the business model, and that you are listening to them as part of this experience, and you're trying to understand what their intentions are, as well as how you can ensure that they get the right products. And the third point is really around managing a response from the regulator. So if they were to come in and to check either on a supervisory visit or as part of a thematic review, are you doing what you say you're doing? Are you doing what we asked you to do? Make sure that you maintain those files for an information request list response, because it will be, let's say, they will give you 1 week within which to return a response following a request. If you don't know where those files are, or if you don't know who has access to them and what the passwords are, it's going to be a bit of a mess, particularly if you're remote working, and there's some difficulties around that the FCA is willing to kind of manage. At least from our recent experiences with them, they're willing to understand that, and there may be delays. But as a golden rule, definitely keep those files in an accessible place. Evidence compliance, the essential compliance that we just talked about, but then also culture. So how you've considered SMCR as through the 4 drivers of culture around purpose, leadership, people, and governance. And then communicating to the FCA the availability of key staff for interview, because a business is not really anything without its staff, as well as the ones who are actually supervising, managing, and affecting the compliance process. And finally, so we've talked a lot about some of the reg changes that are coming in, as well as the reg changes that are happening right now, and even as we see, there's probably some more ones that the FCA is going to come out with in light of coronavirus specific to the sector. But if you have a robust compliance program, it means that you should be able to manage them. And that really starts with a compliance risk assessment. So taking the rules within the FCA handbook, as well as the rules that are applicable to your firm, setting them out in a document that says, these are where the risks are, using that inherent control residual risk formula, and kind of determining where you want to apply your time. Then the second point is around control testing. So you don't know if the risk has crystallized or if it's been managed unless you test your program. So by doing a kind of risk-weighted compliance monitoring plan, which is seen and approved by the board, it means that you have a bit more assurance and understanding that the compliance program you're running is A, robust, and B, that it's actually been looked at by the right people. It's not just been formulated by the compliance function, it's also been looked at by the business and by senior management. The third point is really around kind of separating advisory work from monitoring. It's not always possible because some compliance functions are not sufficiently large enough to have separate kind of people doing advising the business from a compliance perspective as well as monitoring it. But what the FCA wants to see over time is that you're not checking your own homework. So if you tell the business to do one thing and then you sign off on it later from a monitoring perspective, it doesn't really add the kind of challenge that the FCA is looking to see there. We already talked about the board approval of the plan, but the oversight is effectively kind of going through all the lines of the business and ensuring that committee information that you're getting has quality MI, that it has the right people sitting on those committees, and that any decisions are cascaded down quickly and in a way that's efficient as well. We discussed staff training already of key policies and procedures, but I really need to bring it back again because a compliance program is, even if it's structured well, it doesn't matter unless staff can attend to policies and procedures and really understand them, and management understands that they know them as well. The penultimate point is really around systems and controls testing, which is more of a kind of internal audit function, a third line function, which not every firm is expected to have or will have, but at some point down the line to get an extra set of eyes to ensure that those controls that you're setting out in your kind of compliance risk assessment and in your plan, that those are running efficiently and effectively, consistently. And you need to have another party to kind of do that. And whether it's someone within the business or if you have a third party kind of check it on a periodic basis, it does help, definitely short-term and long-term. And the final point there is really around action points. As part of your compliance monitoring, you're going to come up with findings. That's obvious. And that's definitely not a problem because that means that your compliance program is working effectively. But once you have those findings, what do you do with them? Do you make changes to policy and procedure? Do you make changes to your terms of reference? Do you make changes to conduct? And do you make changes to your training program? And who's responsible for these? And is there a timeline within which they have to implement them? So if you can do those bullet points there, you can have a kind of robust and consistent compliance program, which should be able to weather any regulatory amendment that kind of comes through.
Yeah, just a clarification from me there, Yazin, just on one of those points there. You had the separation of advisory work from the monitoring element there, and I think I should draw that out as a really good practice, because often you see monitoring of a process. Are we doing what was written down? But actually, separating that from the advisory work, the advisory is making sure, are we doing the right things, and then checking that those right things are being done. I just thought that was an interesting point just to draw out of those bullet points there.
No, that's exactly right. I'll hand back over to you, Neil, for a wrap up.
Okay, thanks, Yazin. That I think has been a really interesting and thought-provoking summary of the changes that are going on there, in what is probably very timely to have this now. We're a little bit over time, but we've got some good questions. So if people are happy to stick on for 5 minutes, then we'll just try and run through some of those questions. But I'll just do a quick summary now, just to some of the takeaway points, which I think have come from this webinar and following on from the previous webinar that we did. I've got 4 points here really, which I think are good ones to take away, which is consider your processes. Get into the day-to-day of how those practices are actually being implemented, because this is not compliance which sits on a shelf gathering dust. This is compliance which impacts your day-to-day activities. Secondly, it's a complex process, and there might be some need for assistance, but also it should be right-sized. It should be fit for purpose for your organization. I don't think we're talking about massive changes and armies of consultants to do that. It's focusing on the right things there. Which, thirdly, keep it simple. Treating customers fairly it's very easy to remember. It's the objective. If you put yourself in the place of a customer and think, if I was being treated in this way, would I consider that to be fair? That for me is an excellent way of framing some of the decisions and discussions. And just one final point, putting customers at the heart of your business it seems to be a mantra for the FCA. It seems to be what they are all about, looking after that customer. And I think if that's a good practice to have almost in the DNA of your organization. If you're treating your customers well, you're putting customers at the heart of everything you do, you're probably going to be long-term successful. And I think it's really good to see that FCA as a regulator has that to heart and in mind with what they're doing. So that's my very, very quick summary. We have a couple of questions which have come in here, which I'd just like to run through before we wrap up. We did touch on this earlier, but a question that's come up a couple of times has been, COVID, and is there any delay or time delays to obligations? And also, as one of the attendees actually just made a comment, it does now state on the FCA website that they've delayed some publications which were due by the end of June. One of them being motor finance policy statements. It's kind of, would you want to comment on that?
Sure. I guess that the FCA is fast moving on that, and that they're going to move some of their publication arrangements back. I think the way to think about it is, if you were sitting at the FCA devising the statement, ultimately it needs to be signed off by someone internally at the top. So what they do is they have these working groups which will collate information based on the reviews that they've done, and it will kind of sit around until someone is able to review it and look at it and publish it and make sure, in the same way that you'd have any type of communication. If they've pushed that back, it means that that whole timeline is going to be shifted accordingly. So it's kind of probably speaking to their focus at the moment and trying to make sure that firms stay afloat, at least from a financial resilience perspective.
Okay, I mean, I appreciate it's going to be, as you say, fast moving, and they're going to have shifting priorities, in these uncertain times. A question just in, and this is potentially could be a little bit contentious here. We don't believe that sales managers are middle management and therefore do not require certification. They do not have significant influence and are carrying out agreed policies and procedures. Is that something you'd agree with, Yaz?
I think it really depends on the circumstance. And if you look at the definition of the certification function, it's meant to be wider than what the old definition was for the controlled function. So it's individuals who could cause significant harm to the business. If the activity that they're doing is not up to scratch. So ultimately, as a business, if you have individuals who sit above these sales managers, who also sit within the team, who are certified, who can supervise them, then that should be a sufficient kind of compromise. But if you don't have anybody who's certified sitting above them or around them, who has any type of oversight of this process, then I would reconsider kind of assessing where are the stress points in your business where individuals could potentially cause harm based on their activity. And it's deliberately meant to be a wide definition by the FCA to capture parties that were not initially considered to be controlled functions under the old regime.
Okay, so horses for courses, risk management, understanding your particular context, I think are the messages there. What it does highlight for me is even if you have agreed procedures, it's important to make sure that they are being carried out consistently by the people who are on the ground doing that. And that's, that I think is great. Interesting question here. What if we've already furloughed our compliance officer? Do we need to take urgent action, I think is the question there.
Ooh, good question. If you've already furloughed your compliance officer, I think FCA should be notified of any furloughs of senior managers. And do you have someone else in the business who is going to be able to undertake that role of kind of monitoring and assessing compliance? I think that's the key thing. Is there someone else who can kind of step in and do some of that role? I mean, the FCA is not saying that you can never furlough MLROs or compliance officers, but if you have done it already, who within the business is best sat to actually kind of do that role, even if it's not necessarily at the same level? You just need someone to kind of keep you ticking over. So just have a think about that. If you do kind of have new allocations of responsibility, those don't need to be sent to the FCA if it's just in light of COVID. You just have to document those internally. And if you have, let's say, a senior manager who's out for a certain period of time, there's what's called the 12-week rule. So that means that senior manager can, that senior management position can be undertaken by someone in the business who isn't approved by the FCA for 12 weeks, but that has now been pushed up to 36 weeks. So if you get to that 12-week mark and there's someone else in your business who's kind of doing the compliance role, and you're not going to have anybody else come in to do it, and you don't have the approved compliance officer doing it, notify the FCA to get that push over to 36 weeks, and just talk a bit about how you're actually assessing your kind of compliance controls on a periodic basis to make sure that your requirements are all being met. Good question.
Okay, great, thank you. And one final question. It's a question which kind of speaks to services really, but what support is available to guide people through these new regulations? I guess professional services firms and so on. What's available, would you say?
I mean, I don't want to plug too much, but I think there are loads of firms, professional services, law firms, something in between, that what they can do is they can help advise you as to what the regulatory obligations are, business impact, not just from policy procedure standpoint and compliance risk assessment and management, but also operational standpoint. So looking at the business kind of in situ. So if you do have circumstances where you have, let's say, individuals who aren't certified when your peer group may have had them certified, or there's an FCA expectation, it's not just saying that they need to be, it's, let's say, looking at, okay, is there a way that we can justify this and warrant this while staying within the kind of realm of the FCA rules and expectations? So I think firms can definitely help, not only in terms of understanding the regulatory requirements, but applying them to your business. They can run mock audits as well, pretending that they're the FCA or pretending that they're a third-party skilled person to really kind of test what kind of controls you have and if they're being attended to consistently.
Okay, and I think always when looking for a support partner or an advisor, it's look for somebody who's on the same commercial wavelength as you as an organisation, because it's always going to touch on commercial as well as rules and regulations. Okay.
Yeah, agreed.
Yeah, I think we'll stop with the questions there because we are a little bit over time today. I just want to wrap up now, just to say, first of all, a number of attendees have joined. I've seen the attendee numbers sort of going up through the time we've been online here. So there will be a recording on our website if anybody would like to go and see the bit that they missed from the beginning. We will be running some other sessions on some of the learning points around things like home working and use of technology in preparing for recovery. So please keep an eye on the Arena Group website, arenagroup.net, for when those sessions are being announced. And I hope then finally everybody would just join me in thanking Yazin for his time today and for an excellent presentation. And if I can just say thank you to everyone for attending. Have a great afternoon. Stay safe and healthy. And thank you very much.
Thanks, everyone.